What is up, YouTube? What is up, guys? Welcome back to another post trading analysis video. And man, oh man, it has been a juicy day. I haven't been as active. I was trading in the morning, and then after around 1 p.m., I was kind of outside visiting a city, going out for some foods because it's almost my last day here on vacation. I'm leaving Friday, and then I'll be back in the Netherlands. But we managed to catch a nice trade on gold that actually netted us over like 7 to 8% because it was running down more and more, hitting our final take profit. So we're gonna go over that, and then I had a trade on Pepe, which was a break-even setup. I'm gonna go over that as well. And then low-key on Bitcoin, there was some nice volatile price action, and that also reflected back into Solana and Ethereum. So we're gonna go over all of it today, starting with gold, and then we'll go into the rest. So just getting straight into it, guys. Gold on the macro time frame. Obviously, we had this massive range. It was looking like a distribution. We broke up from the distribution, invalidating it, but I am not sold on this pumping higher until we start breaking 2,535. Okay, anything below that could mean that this could still turn into a massive PO3 schematic where this is your range. All of this price action above your range is just purely manipulation before you have the expansion back inside, reversing back down. Because there is a reason to come lower because we have this massive unmitigated daily demand zone. So there is a reason for this to play out. So I haven't really done the correlations with Bitcoin and gold. If I expect Bitcoin to go higher, that gold should go lower or not, or higher as well. TA purely looking at gold. Okay, so putting that range back on our chart. There we go. Zooming in into more local price action. Obviously, price is trending up. Okay, on like the around the 1 hour time frame, but it's probably like also a 4 hour time frame pool. From the low, we're just trending up. This being our 1 hour market structure low. Okay, nothing special about that. Now, knowing that this is our important market structure low, preferably we do not want to break that low for higher prices. Locally speaking, because obviously we have been pumping on the macro time frames. Zooming in to the lower time frames, we can see that we got our first signs of weakness when we got this break of structure right around here. There you go. Break. Reason why I'm pulling it from there is because if I just measure the last pull, right here you had your low. This was your wick, and then you had the lower high. And because you had that wick right here, your market structure low was extended towards the downside. Okay? So we had that break right here, kind of with an aggressive sell. Let's grab the market sessions indicators. So yeah, during New York, you kind of grabbed the London highs. They pushed price down lower yesterday, and then we slowly had that grind up. Now, obviously, this push up on New York, breaking structure, that became our massive supply zone now, right? Because it's a clear indication of sellers stepping in and pushing price lower, leaving a massive inefficiency behind, okay? So, obviously, what can, happen the next day is that, okay, if yesterday on New York, price went up, seller stepped in, pushed price lower, leaving a massive inefficiency behind with supply. Well, if we slowly come back into that supply zone, right? We slowly come back in that supply zone, filling that inefficiency. That could be the purpose of this move up before extending more towards the downside, before therefore potentially turning into some sort of an accumulation, since overall we're still in a higher time frame uptrend. But this is all locally speaking, okay? Price likes to fill inefficiencies. So the same way and the same reason it pumped up here, the same way it dumped down here, filling the inefficiency on the left, the same way it came up here, again, filling the inefficiency on the left. It loves to fill inefficiencies, okay? It loves to have a clean chart with no inefficiencies and supplies and demands mitigated, okay? So to the chart during the London session, and mind you guys, my voice has been is having a tough time right now. So bear with me. But I came to the charts around London. Let's see, where is London? I am not on the correct time zone. There's no way. Oh yeah, yeah. No, I am. My bad, guys. Here. Boom. Boom. So there you go. So coming to the charts right around here, right around here, what have I been seeing? Well, obviously, I have the supply zone on my chart, and we see that we had the perfect mitigation. And I'm watching my structure from the low up because at that point in time, that's my most important structure to watch for further bullish price action or not, right? If we lose that structure from the low up, that could mean that we can get that rotation back towards this low. And from there, we can tap into demand, sweep some liquidity. Who knows what's going to happen? I cannot predict that, right? But I'm coming to the charts here, and I'm seeing this local uptrend tapping into the supply zone. So in an uptrend, we obviously pull our range from top to bottom. Range high, range low. And then let's delete this market structure too. Let's delete this. There we go. And then I am left with this. Now, obviously, what can we see? We have deviation 1 right here. And someone asked me actually, like, hey, don't you think that this deviation is pretty big, right? Pretty aggressive break above. Spend some time above it before coming back down. Well, yeah, you can make the argument for the break being kind of big. The thing is, it had a reason to be this big. The break had a reason, and the deviation had a reason to be this big. Why? Well, it needed to mitigate the supply zone and fill the inefficiency on the left. So that's the argument that you can give for this deviation being a pretty deep deviation towards the upside, okay? Now, even if you're not sure after telling yourself, hey, okay, I'm not kind of sure it's going to be a Wyckoff model, well, then you have to check for yourself, okay, where is my extreme liquidity? Because obviously after deviation 1 and you come back inside, you either have to watch for a model 1, so another sweep of the range high, or for a model 2. And when you have a model 2, you also need to watch, okay, where is my extreme supply? Where is my extreme liquidity or demand, right? Sipping some water, guys. And coming to the charts, checking that. Now, where's my extreme liquidity? I've been having a lot of questions about guys asking me, hey, where's the extreme liquidity? Most of the time, guys, I'm just using the first market structure pool, okay? So the market structure pool from the top down after deviation 1, right here is your market structure high. That's your extreme liquidity. Well, would you look at that, guys? Would you look at that, okay? Right here, there's your extreme supply, but that already got mitigated on the close of the ASA session, so I wasn't awake for all this price action. I like to trade London. So if you were not sure if this was going to be a Model 2 because your tap 2 was kind of aggressive and the break was kind of aggressive, well, the moment you see price deviating the extreme liquidity point like this, coming back down, breaking structure, that kind of already automatically validates the argument of this actually being a Model 2 distribution because the third tap meets all the requirements to perfection. So if you weren't sure in the beginning and then you see that third tap and you get more data, that's when you can also make the conclusion of, okay, yeah, this looks pretty fucking clean. Because it's not just clean from a price action standpoint, the timing, guys. I have been putting a bit more emphasis lately on timing regarding gold and euro because timing in these markets is so important because look at the timing. Look what I've been telling you guys the past few days. Right here, it's 8 in the morning, okay? UTC plus 2 times. Now, I've been telling you an hour pre-London is when aggressive moves happen, and then on London, aggressive moves happen as well. So look what happens. The moment we get that 1 hour pre-London, you get that move down, and boom, massive move up, right? Massive move up, sweeping all buy-side liquidity, deviating that extreme liquidity point, grabbing it, and then breaking structure. That's exactly what you want to see, aggressive price action during pre-London, which is like also like a kill zone if you use ICT strategies, you name it. Like anyone that just has experience knows that these moves happen around these times. So we got the move up that grabbed extreme liquidity an hour before London opens. Then we break structure, and guess what happens? While breaking structure, you leave behind perfect supply. So what happened here, if we talk about it in detail, is first you got the SFP, because you wicked below it, you moved higher. Then we extend our market structure low towards that new wick low, and then that becomes our new market structure low to break. And then right here, you got that break. Boom. Okay, so that's your short. Now, normally, we put our stop loss above our third tap high, but you left behind such clean range supply right here that I didn't want to see price come above that point anymore. So I trailed my stop loss to 0.1, very easy with the calculations as well. And then targeted the range low, okay? Very simple. Now, what happened on London Open? So London Open is at 9. Boom, there you go. What happened on London Open? Well, guess what? London opens, we come down, boom, we get a pullback. Should you be stressing in this point? No, you shouldn't be stressing. Why? Well, London opens because it had a reason, or London opens and it moves up because it had a reason to come up. Why? We left behind clean supply. So if this is going to be a distribution, and especially if this is going to be a distribution with follow through, it will not leave behind such clean looking supply. Okay? It will grab it before moving down. So when I see these markets pre-opening and on opening behaving the way they do, it's like, yeah, this is looking good. Okay? And then the moment London opened and we got that pullback into that supply zone, I knew that this is going to have follow through, right? So I shorted here, okay? I shorted with a 1% risk and target the range low. Not only target the range low, I even said I'm trying to run this down all the way to this low right here. Why? Well, if I check and if I look for support in this area, you're not going to find any support, right? You're not going to find any support. There's nothing in here. You have, if I'm on the 5 minute, for example, you have nothing. This is just all liquidity, right? This is just literally all liquidity. Where's my liquidity to? Well, then just make it dotted. There you go. It was all liquidity, making this your liquidity point. Boom. So pre-London, right? Pre-London, we get that move up, grabbing extreme liquidity. We get the break structure. We get the distribution confirmation. We come back down. London opens. We get the retest into supply, leaving no supply remaining, no liquidity remaining, and then we're moving down. And when you see price behaving that way of leaving no supply behind, leaving no buy-side liquidity behind, you know that you're probably going to have some follow-through, especially also because you have no support below the range low. So I traded and I shorted right here. Oh, my voice, guys. I'm really fighting for you guys. Okay. So the moment I see price behaving in this way and respecting timing to perfection, leaving no liquidity behind and leaving no supply behind, yeah, knowing that this will most likely have follow through, I know that I'm in a winner of a trade. And this is where experience is key and trading psychology is key. Because what most people do, if you have watched my video from yesterday, right? You guys know we made 10% in a single trading day. You made your weekly goal in a single trading day. What most people do when they start winning, they start reducing their stake size, reducing their position sizes. Why? Because they're afraid of losing the money they already made since they already hit their goal. And that's the mindset you need to switch. When you're winning, you should be doubling down because you're winning. Most people double down when they're losing. No, when you're losing, you need to reduce your risk, okay? And when you're winning, you need to increase your risk. So I was already up in major profits for the day. Major. Or not for the day, for the week. So because I'm already up in major profits, I have a major buffer to play with. I can lose 2 to 3% on a single trade, and I'll still be up 7% for that week, right? So what I did is you enter short on the break. I see that pullback into supply, and I short 1%. Again, having a 2% risk on this trade. So now we're short from right here. Stop loss is in the exact same position. Shorting again with a 1% risk. We have a total risk of 2%. We're aiming for this low. That's 2.67, right? Now, with a 2% risk, that becomes 5 plus. So we're in the 5 plus position. We take 50 to 70% out. You can decide what you want. I did 70%, okay? So you're up 5 RR. You take out 70%. That is a 3.5 percent net gain on the account, okay? And then you leave 30% run. Well, this goes from a 2.7 all the way to a 7.6. So that's around a 5 risk to reward increase, right? Make that 10 if you have double the position size. Take 30% from it, and you add another 3% gain on your account, okay? So if that was quick math, that was quick math. I'm just saying that this whole move down was an extra 2 to 3% on the trade, okay? But it's very key here that when you're winning, you should be doubling down on your trades, okay? And don't just double down on any random trade, okay? Double down on high probability trades like this, where, you know, London opens or pre-London, you start to see these moves, you start to see these confirmations. You get that retest on London Open, really giving price no reason to come higher. You only have liquidity below, such an easy target, and then boom, you know, price dumps down from the range. You kind of have liquidity here, sweeps back up, grabs the liquidity one more time, moves price lower, you know. And I haven't watched or traded this price action at all. Okay, I just had to take profit here, so that's the reason why I'm up in major profits now this week, while not even having traded that much, because you're doubling down when you're winning, you know? It's either, okay, look at it from this perspective. I'm up 10%, okay? I'm up 10% this week when I started the day. I have a high probability short setup. I'm like, okay, I could either now lose 1% and make another 2.7, 3%, okay? Not that special. Okay, I'll be up 13%. Or I'll be up 9%. Or you say, oh, I can be up 8% instead of 10, but I could also be up 16 to 17, you know? That's insane. You're still up 8% if you lose. There's nothing to worry about, right? So print this in your mind. When you're winning, you should be doubling down, okay? So that was the gold short from this morning. Now, I also took a Pepe long, okay? I took a Pepe long, and I got stopped out at break even from this setup. So let's talk about that as well, okay? Now, building some context, Pepe was just dumping down. There wasn't really any support here on the left, but we're bouncing from it. And it was very important that we didn't lose the structure from the low up. And the structure from the low was looking something like this, where this is your market structure low. And then right here, technically speaking, you have a break, but it's one candle below it, and then the other candle tap demand. It's the top of this massive demand zone right here, this order block on the 4-hour time frame, and you closed above it. So this is not something I call break, okay? This is something I call fake break, just to mitigate demand and go higher. So even though you have that close below, you haven't broken structure, okay? What I did knew is that we did come into a significant supply zone because this was a strong liquidity. This was a strong order block, okay? This order block grabbed liquidity on the left, dump price down, leaving inefficiency below, and then boom, there's your order block. So this was also the only good-looking order block before taking these highs. So I was expecting a rejection from there, and we got that rejection. And that rejection actually broke structure. So we came into that supply zone right here, higher lows and higher highs. and we actually broke structure here, okay? So expectation of order flow after breaking structure, after an aggressive move up, is obviously a lower high for a lower low. Now, we actually got the lower high for the lower low. And then obviously when you're in the downtrend, because you are in the downtrend right now, you pull your range from bottom to top, and then you have something like this. Right? Then you have something like this. Now, range low, range high, there you go. Okay? What followed was a deviation from the range low during Asia session. Okay? During Asia session, you got the deviation from that range low. And right below that range high, you had this juicy looking massive supply zone. Okay? So my initial idea was, because we just had this aggressive expansion towards the upside and we broke structure after tapping into the only good looking supply zone there was, and I was, hey, potentially this could be a 1, this could be a 2, this could be a 3, where I'm expecting lower prices, so this could be an accumulation that goes over into like a distribution, right, where you have the 2 and the 3 here. So that was my initial idea of, hey, this accumulation could go over into a distribution, and I'm also obviously looking for some sort of an accumulation schematic. Well, when I come to the charts, what you can see right here, this is 6 in the morning. What does price do at 6 in the morning? Price comes up, we break structure back inside the range right here. We leave behind this demand zone. This becomes our extreme demand. It's the last demand remaining before tapping that range low. And then price comes back for it. This could be our third tap of the accumulation schematic. And then where do you confirm that? Well, if you break structure from the top down, between tap 2 and tap 3. So this is tap 2. So this is tap 1. This is tap 2. This is tap 3. What's the highest point between tap 2 and tap 3? That's right here. If you break structure from the highest point towards the third tap low, back to bullish like this, that's when you confirm the accumulation schematic. Okay? Now, if we watch our structure from top to bottom, we get lower highs and lower lows. There you go. Right here, you break structure, back to bullish, boom. That's when your accumulation schematic is confirmed, okay? Now, mind you, I wasn't behind my PC at the exact moment of the break of structure, okay? I came right around here, literally right around there, a bit before 8, okay? Like I just said on the gold setup. So I wasn't aware of the immediate break right here on the higher time frame. But what happened is we got the break of structure, we got the move down, we got the move up, right? So following your structure, break of structure, and then expectational order flow. I don't know if that was, yeah, that was it. It's higher low and higher high. That's what you got right here. And then it happens, guys, it happens all the time where you get like these fake breaks before actually moving. Oftentimes when you have these fake breaks back to bearish before actually moving, is because there's some sort of demand down here that price wants to mitigate before moving higher. But you get them all the time, like all the time. Don't bother price breaking back to bearish immediately after breaking back to bullish, confirming a accumulation that looks this clean with a 1, 2, and a 3 that has also a return to zone, because this break just confirms the accumulation schematic. If you get a break in premium pricing, it's a different story, okay? But this is all in discount pricing. So if you get a break back to bearish in discount pricing after breaking back to bullish, you know, or after breaking bullish, immediately after you get a break back to bearish, oftentimes they're fake breaks if the accumulation schematic is looking this clean with your 1, your 2, and your 3, okay? If you get a break back to bearish in premium pricing after having an extensive move up, that's when you have to look at things differently because you had some sort of range rotation already, okay? But Came to the charts. I saw this move down, this fake break of structure. This is some sort of demand, but really it's nothing special. And I just longed. I just longed, stop loss below the low, and then moved up higher. Okay? Now, obviously, I am targeting the range high because we have these liquidity zones or these buy-side liquidity points on the left. And in general, the target of an accumulation schematic is the range high. And this is where I was looking for price to turn into a distribution, tapping this supply zone. Okay? So, very easy. 1, 2, 3. The break of structure confirms it. We have a return to zone. In general, with the macro context, I'm looking for an accumulation into a distribution. But guys, the reason why this was a bearish trade is because if you've been following me for a while, you should already know this right now, that if we follow price from that point up, we can clearly see what happened here. Price turned into a distribution. Boom. Price turned into a distribution where you have your 1, you have your 2, and you have your 3. Okay? Very clean distribution schematic. The thing is, it's just untradeable on the 1 minute. This would be a schematic that would be tradable on like the 30 to 15 seconds. Okay? And that's why I'm telling you guys that you can trade this shit on any time frame. Like, honest to God, you can trade this shit on any time frame because you can clearly see that it works. This is a 1 minute range. And you have your 1 tap, you have your 2 tap that left behind this order block. Price came back into it. And then I bet your ass that on the lower time frame, like the 15-second, that's a market structure break. Yeah, there you go. There is your 15-second market structure break, guys. Like this shit works on the seconds sometimes, right? You can see it here live. But neglecting the seconds, going back on the 1 minute, price distributed in premium pricing while there was no resistance here. There was no resistance here. Price should have just shot up and tapped into that supply zone, but it didn't. Like, why did it have to distribute? Because below us, we didn't really have demand, right? Let's say we had a massive, good-looking demand zone right here, okay? Let's say that was the case. I would say, like, yeah, okay, we could have this distribution, this 1, this 2, this 3, to mitigate demand and then go higher. But there wasn't demand here. Matter of fact, there was just liquidity. So if I clean up the chart, because I like to keep my charts clean, if I clean up the charts, we had our 1, we had our 2, and we had our 3 right here after mitigating demand, just like every model too. The moment we had the distribution here, this 1, this 2, this 3, and I saw nothing but liquidity right here, I was like, nah, this is not looking good. There's nothing but liquidity. Matter of fact, my stop loss is here, right? My stop loss is right here. So at that moment in time, I just moved my stop loss to break even, and then I got stopped out on this move towards the downside, okay? And price started coming lower. Now, then I got the questions of some people that traded a different Model 2 schematic, and they traded, let's get rid of this, guys. They traded, let's just do this. There you go. They grabbed their extreme liquidity point. Normally, this would be your extreme liquidity point, but it's so close to that second tap that it's kind of 1, so you kind of ignore that. So just grab these equal lows. Here's your liquidity point. Just your first mark structure pull, like always. And there's your extreme liquidity point, okay? And then people ask me, hey, I took this Wyckoff Model 2 accumulation. It grabbed extreme liquidity. You can even say that this is some sort of wick demand, which is even more a more refined way of applying extreme demand, right? And we got the break of structure. Why did this not work? Okay, why did this not work? Well, first of all, in my opinion, right, this wasn't that significant. The moment price filled this inefficiency right here, this imbalance in the chart, tapping into the top of that demand zone, leaving behind this buy-side liquidity while coming down, that was already, for me, enough to call this a proper third tap. So, normally you can make the argument, let's say something better was waiting below you. You can say like, oh, but it had, it didn't hit its target because it had to come down to mitigate this before actually moving higher. I wouldn't particularly say that with this situation because it wasn't that good looking. Like, in my opinion, this was a proper third tap. So using my views, I would say like, okay, if this wasn't your third tap, why would this be? Because this wasn't a more significant area, this was already a proper third tap. Price failed to take out the high. You had the distribution. It came back down. If there was an even more clean looking POI in here, I will be like, yeah, you can make that argument. But in this situation, that argument wasn't there to be made. Okay. However, if you still trade this accumulation, which I don't think is a bad thing, okay? Because in my opinion, does look pretty clean, okay? I wasn't even online anymore at this point, but it did look decent, okay? So let's say you still traded this accumulation. How could you have not lost money on this trade? Well, if you're watching the break of structure right here, and this is all on the 2-minute time frame, let's see. We also have on the 3. Okay, 3 is also fine. You can enter on the break. Let's say you entered on the break right here. What would that risk to reward be? Okay, well, I'm entering on a Wyckoff Model 2 accumulation where this third tap didn't really do much more than this third tap, and that third tap failed. Now, I can target the range high, but is it actually the same? No, because when I target the range high in here, you had buy-side liquidity above you, and right here you also had buy-side liquidity. But you swept most of that buy-side liquidity on that first move up. So what you're targeting now is the same point without the return to zone. You don't have the return to zone. Matter of fact, you just have supply remaining right here and supply remaining right here, right? So the return to zone isn't there as well. While you're also only trading a 2.5% risk to reward. It's kind of decent. Loki, that's kind of decent. But I wanted to make a reference before I went into the trade about the return to zone was also gone. Okay? But let's say you still took the trade. Let's say you entered on that break, 50%. So you entered on that break, and then I could see in a 3-minute that you had this 3-minute demand zone. Boom. Let's say you entered 50% on the break and then 50% on the retest of supply. Okay, because right after the break, it didn't look the best because you can see the 1, you can see the 2, you can see the 3 tapping into the supply zone. Okay, so it wasn't behaving best, but let's say you were convinced and you still took this full position size. Okay, you're taking a position size around here and around here. So let's take the average of the middle of this point and that point. Your average entry is right around here. Let's take the worst case scenario. Boom, and your stop loss is 0.7%. Okay, 0.7%. And you're targeting the high. Now, the moment you break that structure, okay, and you tap into demand and you move higher, knowing that you're coming into an area of resistance, the moment you have a new market structure leg following this red drawing, okay, you control your stop loss from this low all the way to this low, right? Because there's no reason for price to come lower because you tapped all demand remaining below you. Why would price break structure back to bullish in here after mitigating all demand just for price to come lower again and then higher? It doesn't make sense. So if it doesn't make sense for price to come below this low again, that's your new invalidation. And if you risk 1%, okay, if you risk 1% when your stop loss was 0.7 and now your stop loss is 0.34, you're risking less than 0.4%. You go from a 1% risk. So let's say you risk $100 when your stop loss was right here. Now you can trill it, and now you're only risking $40. Okay? See how you can manage your trade and minimize your losses in this way? Because what happened since then is if you followed it, this was supposed to be an easy move, guys. This was supposed to be an easy move. Just like this right here was supposed to be an easy move. But guess what happened? You start retracing. Now here you had a way clearer signal because you had the 1, you had the 2, you had the 3. You didn't have that right here, but that third tap also wasn't really a good third tap because that was the proper third tap and not this one. Okay? So that's kind of how you could have debunked that Model 2 accumulation by paying more attention to how price was behaving before putting in that tap. And then I think what happened from there is we turned it into an accumulation schematic. Yeah, it was a Model 1. 1, 2, 3. And then price moved higher. So the Model 2 fell, so it could create a Model 1. Then you have to ask yourself, was there a reason for this Model 1? Well, there was a lot of liquidity here, but you didn't sweep all of it. You swept until this point, which is kind of an equal low. Kind of awkward. Yeah. It just didn't sweep that low. That's unfortunate. That would have made sense, though. It just missed it. Maybe on another exchange it actually swept that low. Because then you could say, yeah, that was the clean liquidity sweep, right? But, yeah, you had the Model 1. Did you have the confirmation in there? Oh, yeah, actually did, but it was fairly aggressive. Yeah, it was too aggressive. So right here you got that break of structure, but the candle closed all the way up here. So at that point in time, you don't want to be longing with your stop loss all the way below here, right? Just to target that high. That's a 1-to-1. No, that's not something you want to trade. Okay. And since then, we have been chilling. Okay. Okay. Let me have a sip of my water. Another trade that I took, I don't know if it was yesterday or the day before, but it kind of took some time to play out. And I'm still in this trade. Right now, I'm just fully de-risked, right? I'm fully de-risked because there's no reason to risk any more money on this trade. And it was this Solana Model 1 short, okay? So Solana had this good-looking demand zone. They're like, oh man, if we could come in here, that would be that would be the most easy Wyckoff Model 2, 1, 2, 3, massive macro accumulation schematic. So I know if we're gonna go there, but just know that if we go to that 124, 125 area, I'm gonna start looking for massive longs. But locally speaking, right? Locally speaking, we were just downtrending with lower highs and lower lows. So in the downtrend, you pull your range from bottom to top, just like I did right here. And then you can clearly see going over it a bit faster that you had your 1, you had your 2, you had some sort of a 3 here. Wyckoff Model 2 accumulation schematic that went over into an extended 1, 2, 3 Model 1 distribution schematic. Okay? And now, there is actually something to pay close attention to regarding this Sol short. And it's something that if you guys master this, you can catch trades that have such better risk to rewards because you just know when price is going to move, okay? And when it's already confirmed that price is going to move. So this was your initial range high on Friday, okay? Now on Sunday, you get that deviation, and then on, I think it was Monday, or on Tuesday during Asia, you get that third deviation. Mind you, I don't trade Asia, right? I don't like Asia in general. Even if I would trade it or if I could trade it, I wouldn't trade it. But right here, okay, You even got your third tap with a breakup structure, but it was a fake breakup structure because price ended up going higher, okay? And it was during Asia, so obviously I'm just sleeping. I'm not aware of this potential third tap at that time. But the thing you have to pay close attention to is that is there a reason to come higher after putting in that third tap, especially if it's a third tap during Asia? And the answer is yes, because if you look at my chart closely, okay, if you look at my chart closely, you can see this 30-minute order block. And if I go on the lower time frame, you'll see that this 30-minute order block is just simply this last push up before dumping price down, leaving this tiny inefficiency that just didn't get filled on that wick, on that retest wick, right? And then if we switch to the 30-minute time frame, this is an order block. And it's kind of just a supply zone that's part of just, this bigger range deviation schematic where you had that range high right here that got deviated. So definitely in this entire area, you had that liquidity sweep pushing price down lower, indicating sellers stepping in, right? So it is a good looking supply zone. So we have a good looking supply zone right above our range high. And then we get that third deviation on Asia, which again, I'm minding you, I wasn't aware of it even happening, okay? I came to the charts at 7, 8 in the morning, seeing that Asia had that fake break, okay? But we're watching this Model 1 distribution schematic, okay? And we're seeing this amazing return to zone where all of this is just straight up liquidity, okay? Which makes for a nice rotation down. Now, we get that third tap on Asia, and it's a fake break. So then you have to ask yourself, is there a reason why on Asia it was a fake break? Well, yes, because there was still inefficiency to be filled right here. There was still inefficiency to be filled, fair value gap, and supply to be mitigated, which this third tap during Asia did not do. So price comes back up, and now I can hear people already saying, but you have a 4 tap now, right? A 1, a 2, a 3, and a 4. No. This is a situation where low time frame schematics can go over into higher time frame schematics. Because if I go in the 3 hour, this is still a valid range, and this is just all one tap, okay? If this is still a bit not clear to you, I highly suggest you go and watch my Wyckoff tutorials. And in the part 2, I go over low time frame schematics going over into high time frame schematics, okay? It's all already explained, so I highly suggest you check that out. But yeah, even on the 50-minute, if you had a valid market structure pool and it looks like a 4 tap, on the 3 hour, this can just be one deviation, so that can still be valid. The thing is, talking about how to get those better entries, is that we have been watching this Wyckoff Model 1 idea the entire time. And now that price has come back up and you have mitigated this supply zone right here, now there's no more reason to come higher again, because the inefficiency has been filled and the supply has been mitigated. So if you are convinced of this Model 1 idea, and now you finally have a third tap where there's no reason to come higher if price rejects there, you can just watch your most local signs of weakness, because there is no reason to come higher. So if you go on the 1 minute, you can see right here, you already got that breakup structure. Right here, you got that breakup structure. Boom. Now, mind you, when you take the trade right here and you target all the way towards the low, which is the technical target, you have an 11% gain on the account if it hits, if you take one take profit. The thing is, I always tell you guys, right? Hey, take into consideration the size of the range and then the break of the range. And preferably, you want to have a break that's back inside its original range values. So following 50-minute time frame structure, it is best to wait for that break right here, okay? It is way safer, way safer to wait for the break right here, because that's a break back inside your original range values on a mid time frame, like the 5, the 10, the 15 minute, and it's just way safer. But guess what? Safer will also give you less reward. So once you start understanding these Wyckoff schematics more and more, so I'm mainly talking to the more advanced people that have been watching me for a longer period of time. Once you start understanding these schematics more and more, and you start getting better at building context and giving price reasons to come higher or lower or not, and you see this distribution that you've been eyeing this entire time, and you finally hit that POI where this is the place to reject, you can just watch for the most local signs of weakness. And the most local signs of weakness is that 1 minute break. Because ask yourself, after mitigating the supply zone and filling that inefficiency, why would price come up one more time after the break before dumping down, right? It doesn't have to do that. It doesn't make sense to do that. So that's why you can already get an entry right there. That's why my entry is there right there, you know? The thing is, I don't want to push that. So that's why I haven't been pushing that entry, because I don't want to push that on the people that are watching me right now, is because they will just see my risk to rewards and start, trying to enter too early. No. If you're just, figuring this stuff out and you're just watching my videos and you're practicing, wait for these 15-minute breaks like this one. It's way safer and you can still make so much money. But once you start understanding it more and more and you start understanding context more and more, you can get these better entries. Okay? Now, after breaking this 15-minute structure, leaving behind this nice supply zone, which we still haven't mitigated, I think, to this point, also breaking back inside this volume profile, there's no way I want to see price exceed this point again. Like, there's no reason to. Unless it's going to be like a Model 2, like a one that goes over in the Model 2, where it grabs extreme liquidity right here, but then I'll just re-enter. And I don't want to risk losing money on that trade when it's looking like that, right? So right now, we got an extensive move down. I hit a take profit around this volume area low, grabbing some of these sell side liquidity lows, but it was like around 20%. And then my stop loss is drilled in profit above that order block high. And then that's it. I'm either letting myself get stopped out for a bit more profits, and I'll make like 1%, 2%. But otherwise, I'm like making 10%, which is very nice. But the thing is, I've also just made a video about me being more bullish than bearish on Solana. And someone else asked me this today actually as well, of like, hey, what if you're long on one altcoin and short on the other altcoin, And can you still do that? So right here, we have a very clean looking distribution on Sol. Now, Sol is way more volatile than Bitcoin. So if I'm bullish on Bitcoin, but I'm seeing this on Sol, you can still take it, because if Bitcoin moves down a few percent, this distribution schematic can be completed on Sol. Same for even smaller altcoins, right? So that's why you can kind of trade Sol and Pepe in its own way, And especially even smaller alt caps compared to Bitcoin, you can trade them in its own way. But if you go long on Matic and short on AVAX on the same time frame, on the same type of confirmation, then it starts getting weird, right? Because they will not move anti-correlated. Like, it's still crypto. It will probably move up or down, both. So you can long and short Bitcoin and Sol, or Sol and just Bitcoin and Sol, or Bitcoin and Pepe. Or you can go short on Pepe on like the 3-minute time frame while being long on Sol on the hour time frame. That can still work, but you cannot go long and short on different pairs on the same time frame schematic, because that doesn't make sense. Okay. But I made a video about me being more bullish than bearish on Bitcoin, and Bitcoin has been pumping. So I wouldn't be surprised to get stopped out on this Solana short. Like if Bitcoin had given the green light to go lower, this would have been an easy trade, and we would already been smiling in profits because there's nothing but liquidity right here below these lows. But I think Bitcoin is going to run eventually, right? We are leaving a lot of liquidity behind right here, but that's just typical Bitcoin. Every time Bitcoin decides to run, it starts to leave liquidity behind. So I know that by now. We've been talking about this Model 2 accumulation schematic that's untradeable on this time frame, but still looks extremely clean, right? So that's the trade on Sol. So I'm recapping it for myself right now. We talked about gold. We explained Pepe. Then we explained Sol. Now Ethereum is the last thing I want to go over into, because Ethereum, man oh man, this range has just been absolutely nuts. Like this range has been absolutely nuts. In the fact of there's Wyckoff everywhere, and you're kind of sandwiched in between Wyckoff. And what do I mean with that? Well, we have this range here, right? And you had your tab 1. You had your tab 1. You had your tab 2. And you had your tab 3. Wyckoff Model 1 distribution short that we absolutely nailed together. But that kind of went over into a 1, a 2, a 3, aka a Model 2 accumulation. And since then, so you have a Wyckoff Model 1 distribution at the top, and then a Wyckoff Model 2 accumulation at the bottom. And since then, you have been sandwiched in between the both of them. So yeah, is this going to come down to fulfill the distribution, or is it going to come down to fulfill the accumulation? Because we still have supply up here as well. And we know that distributions can be extended, meaning this Model 1 distribution can go over in the Model 2 if we come back up and reject again. So we've been ranging, being sandwiched between the distribution and accumulation. And then guess what? Even this range was looking like either a distribution with a deviation at the top and an accumulation with a deviation at the bottom. So you were really sandwiched in between everything. But I saw a few people talking about this local, it was like a local accumulation schematic, where it could be turning into like a local distribution schematic or something. But they are not aware of this range that's going on. And mind you guys, I'm always using the Bybit chart. So for Bitcoin, I'm using Bitcoin USD inverse, because that's just the best chart to use from personal experience. And then for any altcoin I trade, I use the perpetual contract chart of Bybit. I don't use any other chart. Even if you are trading on a other exchange, you still do your TA on Bybit, okay? So you do your TA on Bybit and you just confirm the entry on your own little exchange. But on Ethereum, you had your 1, you had your 2 at the top, you have your 1, you have your 2 at the bottom. You have a lot of liquidity at the top, I can tell you that. And then price came down one more time. So we started ranging after putting in that deviation. And then right when, Pepe had that move down, Sol had that move down, Bitcoin had that move down, Ethereum also had its move down, confirming this as a potential Wyckoff Model 1 accumulation. Did we get a breakout structure? Yes, we did. But just like on Pepe, it was very high up. I don't know if there was news. Maybe it was news. What is this time frame? No, it's not even on like an exact moment. No, it's probably not news. Damn. Just an aggressive sell to buy, which is something you like to see, right? So it's looking like a Wyckoff Model 1 accumulation in an area and in a range where you already have a massive Wyckoff Model 2 accumulation going on. So, I'm just letting price range in here, trying to see if we can get local trades tomorrow. But I haven't traded anything on ETH, but it's just very fascinating to see to have so much Wyckoff in one place in the chart. Okay, so recapping it before wrapping it up, we had a Wyckoff Model 2 distribution short on gold, where I had a 2% risk because you double down when you're winning. And the reason why it was so clean is because supply was mitigated and efficiency was filled, or inefficiency was filled on the second tab. The third tab grabbed extreme liquidity to perfection, broke structure, and then from a timing perspective, the move happened pre-London and you got the retest on London, while also having a lot of sell-side liquidity as a target. So that was the gold distribution short. Then we had the Pepe long, and the Pepe long got stopped at break even because it was looking like a valid Wyckoff Model 2 accumulation. and we traded the valid Wyckoff Model 2 accumulation, but it turned into a distribution after having a move into premium pricing, and we had easy liquidity to be grabbed, so we didn't want that to happen, and it did happen, so that's why we de-risked ourselves, and then we got stopped out, and then I wasn't even online to trade the rest, but we also declared why this wasn't a good Wyckoff to trade in general. And then on Sol, we had this Sol short. The reason why I had such a good entry is because reading context is key, but that's something that will come with experience, and I'm still in the Sol trades in profit with my stop loss in profit. And then on Ethereum, we have Wyckoff everywhere. So that was it. Fully recapped for you guys. My voice is completely gone, and I'm not even sore or sick or what though. I've just been talking all day, and my voice just leaves me at night. I don't know what it is, but I'm gonna be back in the Netherlands behind my home PC setup next week. So I'm flying Friday, so I'll be back soon home, or I'll be back home very soon. Love all of you guys that have watched to the end of the video. Appreciate all of you. You're all gonna make it. Big things are coming, and see you later, guys.